another thing that's positive at the margin is that this economy is with positive and negative. It depends on what direction the stock market's going, but it's this hyper financialized U.S. economy is more sensitive to asset markets than ever. And what I mean by that is if you look at the share of private non-financial sector credit that is on bank balance sheet, it's only at 32%, which means that the shadow banking sector is accounting for, the other, let's call it 70-ish% of private non-financial sector credit. That compares to, roughly around 50% for Europe and roughly only around 20% for China. So this is a very hyper financialized U.S. economy that is very sensitive to credit spreads, very sensitive to stock market. That's what makes the economy go. It used to be that, hey, you forecast the economy to predict where the markets are going. But now that process is a lot more reflexive. You don't understand where the economy is going based on looking at the market. And ultimately, you can understand where the markets are going based on looking at your projections for the economy. So that's a much more tighter reflexive process, which is partially why you saw the improvement in a lot of economic statistics in July relative to June and in August relative to July. So will that improvement continue? We're going to need to see positive outcomes from the perspective of the asset markets for that to continue. This is partially why, again, the improvement in financial conditions that we've seen, the easing of financial conditions we've seen off the June lows is partially why indicators of financial stress are declining. So this is data from the New York Fed Survey of Consumer Finances here, the July data. And what we're showing here on the right side of this chart is looking at the percentage of respondents who are expecting to miss a minimum debt payment over the next 3 months. This is the under 50,000 cohort from an annual income perspective, 50 to 100,000 and over 100,000. As you can see, we're moving in the right direction. It's 16.6% in July. It's actually down from 17.3% in terms of low-income consumers expecting to miss a minimum debt payment. We're actually down in terms of median income consumers and way down in terms of upper income consumers, which actually makes the most sense, right? These are the people who own all the stocks and credit in the economy. One thing I'd also call out is that relative to the pre-COVID trend, we're actually better than we were. With all this inflation, you would expect investors, or not investors, consumers to be a lot cash strapped. They're not cash strapped. They're telling you it's actually better today than it was in the pre-COVID era, because again, all this credit is nominal. We're talking about nominal economy now. Now, real versus nominal, I think that spread between how you think about the asset markets is actually widening in terms of real versus nominal. It used to be all kind of the same thing, but now we have to start looking at certain different indicators like this to understand the impact of some of these nominal dynamics upon the broader economy, upon corporate earnings, because again, it's not this linear relationship that it used to be in terms of real versus nominal. So this is something I definitely wanted to call out, because again, it kind of pushes back on this view that consumers are strapped and, everyone's falling off the cliff in terms of debt serviceability and et cetera, et cetera. That's just not true when you look at the actual data. Reminder, U.S. households have $3 trillion in excess savings. I pause for dramatic effect. I mean, this is literally relative to the pre-COVID trend. We have $3 trillion in excess savings, $4.5 trillion in total savings. If you look at cash and checkable deposits on U.S. household balance sheets, it's extra $3 trillion relative to the pre-COVID era. So again, consumers are flush with cash. They're obviously pissed off from a consumer confidence perspective because their wages are not keeping up with the change in prices. But it's still not the end of the world. I mean, they still have all this cash on the sidelines. You look at total net worth, just nominal net worth, 149 million, big excess relative to the pre-COVID trend. And then you look at net worth as a percentage of disposable personal income at 818%, or it's basically a ratio of 8x of disposable personal income, very clearly in no man's land to the positive side of the ledger on this chart. So the U.S. household balance sheet is good. There's no way ifs, ands, or buts about it. It's a good balance sheet